大家好，对不起，我不会中国语说，我说英语好不好？好，不好，不好。We have a big problem. So I know I've seen some people introduce themselves. I want to ask a question. How many of you are looking to raise capital for your business? Raise your hands. Nobody?
Everybody.
What about people are looking to make investments locally in BC? Anybody? Nobody wants to make investments. Everyone wants to raise capital, right? Good. This is probably the best place to be. The topic heading is basically based on 17 years of experience. I put together 7 reasons why entrepreneurs haven't been able to raise capital. And let's look at reason number 1. Reason number 1, why would an investor be attracted to your business or project? You really have to, as an entrepreneur, think about that. And that's because, number 1, investors are busy people. Number 2, you're not the only opportunity that they're looking at. We all know entrepreneurs, as you know, when you're building your business, you're passionate about your business, you live your business, that's all you see. But, more importantly, does the investor see the same? You must think about that. Another key point. Is your project suitable for that investor? Not every investor, as you know, when you make them, are going to be interested in your project. So you need to find who's going to be your suitable investor. And I talked to Stephen a couple weeks ago, and he asked me questions about investors. I was going to meet with one, and I said, sounds like it's a little bit frustrating. And I said, does this person happen to be Chinese? Is this person wealthy? Is he an entrepreneur? He looks to invest. I said, yes. However, does he have the background that would be conducive to be an investor here? So that's really key, suitability. And how do you do that? Target suitable synergistic investors. Where do you go? You speak to people like myself. There's the Angel Forum, there's BCTIA, there's Wavefront, there's BCIC. There's a lot of different industry sectors that focus on your particular industry. So you need to go out there and meet these people. And as well, in your own association, you must have others that have done business with other investors. So this is the networking. Another key point, your message. You gotta have a clear message. Easy to understand. And this is very important. How many of you heard of this radio station before? WIIFM. How many have heard about it? WIIFM. No one? Well, this list, the acronym means what is in it for me. I'll repeat that again. What is in it for me? Not for you, for the investor. You need to know what you're offering to that investor, why they should be investing in your business. And again, I learned a little bit about Stephen's business. So just to put this into perspective, if I can use your company as an example, you're looking to raise capital. You're looking to go into the mall. So when I go meet a potential angel investor who's a retail investor, what do you do? Well, maybe in simple terms, I go into a mall. I help store owners increase their sales by 25% through my smart kiosks. Keep it simple, keep it clear, and what is it in it for the investor? The investor, if he's a retail investor, will understand that 25% costs next to nothing if you can use something that generates that revenue. Well, in essence, that's an example. Reason number 2, are you ready for an investor? And this is honestly a lot of challenge for a lot of entrepreneurs. Because first and foremost, you've been running your business your own way, but when you have an investor, there's expectations. So you have to know, are you ready to address those expectations? Because now you have a partner, you have an investor. I'm sure you've seen these words before, accountability and reporting. You see this individual here, when you start having investors, now you have to be held accountable when you start to report. Not only that, there's a point of transparency. You now have to disclose. If business isn't doing so well, you need now to open up and discuss that. How are you going to fix it? Not just discuss it. Find solutions. Number 3, what type of financing are you looking for? The traditional 2 types are debt and equity. Most entrepreneurs just look at the dollar sign. What is your structure? How are you going to offer it? Let's go into equity, for example. Equity financing, first and foremost question, how much equity are you willing to offer an investor? How many people have watched Dragon's Den or Shark Tank? There you go. The first question they ask is how much you want and how much you're willing to offer. Well, you need to determine what you're willing to offer. Everyone wants to offer as little as possible. But you need to know, because this is important, the second question comes up. Is your valuation reasonable and justifiable? So if you're asking for $1 million and you want to offer 10%, you're saying your business is worth $10 million. So now, that is something that the investor has to justify. Is that reasonable and justifiable? You, as an entrepreneur who's looking to raise that capital, need to be prepared to justify and say, yes, it is, and why. And third, as an investor, you become a shareholder, and most likely a director in your company. So they will be participating alongside with your success, ideally helping you. So that's a little bit about equity financing. Let's talk about debt. Yes, most likely they won't hold shares in your company. However, they most likely will hold a board seat in your company. That'll give you some idea of what they're going to be looking to do. They will monitor your business. They will ideally help you with your business. The other thing about debt, you have terms, conditions, and covenants. This, in essence, is a lot more stronger than being a shareholder because you can have a minority stake and can't do anything, but as on terms and conditions in your loan agreement, a general security agreement will have more power than a shareholder. You can exercise those powers. So things to be considered. Also as well, debt, you can't always tend to get the capital that you need. So if you need $1 million, you can only qualify for $300,000 because you'll have only enough collateral and cash flow. As well, you have to look at your ability to service. So it's almost like a bank. When you're looking to raise debt, you have to understand what is it that you can do in terms of your cash flow, your collateral, and your ability to service. Okay. Number 4, when you are able to raise the capital, do you have a budget and an explanation of how you're going to use that money? And this is what we call use of proceeds. A couple examples are new equipment, marketing and sales. As you all know, we need to grow our business, generate revenues. Working capital, we need to hire people, pay the rent. More importantly, as you know, in your business, research and development, and continue to grow the business. And you may have an opportunity to acquire somebody. So you need to look at what is it that you need this capital for. And these investors will ask you for that. And then in the stages of an angel or early stage startup, the last one's less important. The first 3 are the most important. And the other things that people tend to forget, most entrepreneurs tend to forget when they're raising capital, they forget about finder's fees and financing fees for people like myself and brokers who help raise that capital. And in some instances, some venture funds do charge fees. So you need to be aware of these things, and you have to include that in your budget. And these fees tend to range anywhere between 5 to 10%. You notice there's a plus. If you're looking to go public, that plus is usually in the form of a sweetener or what we call broker warrants. So if you are raising $1 million, for example, in the public markets, a 10% fee is $100,000 cash that goes to the brokerage firm or the finders. Then you probably most likely will be paying another 10% in broker's warrants. So it's not a 10% fee, it's a 20% fee. Just want to make sure you be aware of that. Number 5, boy, this one's always seems to be a kicker. People tend to have a hard time. Do you have a business plan? All those first 4 things I've said, all culminate into a business plan. And why? Well, without a business plan, as you know, your chances of raising capital really low. And most entrepreneurs think it's a waste of time. And why? I hear this constantly. Well, my business is always changing. Well, your business shouldn't be always changing. The outside of it may change, but the core business should never change. If your core business ever changes, then it's not a good business to go in. is understand that the market changes, but your business should not change. And part of the business plan, again, not to be long and drawn out, it should be clear, concise, and really it's a roadmap to explain to the investors how you're going to achieve your objective. Another important thing in the business plan, what is the ROI, return on investment? Every investor wants to know sometime in the future, what is it going to be that my return is going to be? Was it going to be 10%, 100%? That's something you need to consider, and you need to build that in as part of your business plan. And the other question is that return high enough to attract investors? So these things are needing to be planned ahead as part of your business plan. Next, I'm standing up here, how strong is your presentation? This is a very critical component. Why? Because when you write your business plan, you put all this information in, you've got to be able to communicate that information as clearly, as effectively, and as simply as possible to your investor. And here's some tips. Obviously, you got to be prepared. You got to practice. Get some good friends who are not going to be hesitant about telling you the truth, what your presentation's good or bad. And you know what? It's actually very constructive. At first, it feels a little uncomfortable, but I tell you right now, it's probably the best thing you can do because it helps you be prepared. Again, it's like your business plan. Keep it focused and don't sway. This is an important thing. It's easy to get nervous in front of pitching an idea. And if the investor starts to see something else that he or she doesn't like, it's easy to try to jump off onto another topic to try and catch their attention. Ideally, don't do that. Focus and keep in your direction. Don't digress. Because investors really, with who they're buying into you and your idea, and your ability and your team's ability to execute. And be prepared to do a lot of presentations. Guess what? One presentation is not necessarily going to raise you that capital. There was one instance that I did do a presentation for a client who did raise the money, but that doesn't happen a lot. And you usually build a lot of relationships, you build a lot of trust before that happens. Unless you're going to have that trust relationship, most likely you're going to need to do a lot of presentations. And it gives you a lot of practice too, to hone in on your skills. So next step, final step, reason number 7. What is your exit strategy? Investors are not going to be married to your business from beginning to end. They will want to have a time to move on, to make money. So you need to look at a timeline, usually 2 to 5 years. Unlike in China, where you have the pre-IPO type of investments where they're a year, we aren't seeing those anymore, as you know. But in Canada and North America, they're usually 2 to 5 year terms. You may, instead of going the IPO rate and the M&A side, you might want to have an option in your clause to say, I want to buy my business back if I'm able to successfully achieve my goals. And that you can negotiate with the investor. I think a lot of investors are happy to see that someone's making a commitment to buy back their shares at a predetermined value. So everyone knows that if you're successful, you're going to carry on your success and be able to buy your business at a reasonable price. As you know, the traditional other exit strategies are the acquisition, the merger, and the IPO. So to recap, number 1 reason, why would an investor be attracted to your business? So you think about that. Number 2, are you ready for investors? Number 3, what type of financing are you looking for? Really important. Number 4, do you have a budget, an explanation how you're going to use that capital? 5, very important, is business plan. Do you have a business plan? 6, how strong is your presentation? Very critical, because you're going to do a lot of it. Number 7, what's your exit strategy? Very clear. At least have an idea. You can go to LinkedIn or Facebook or Twitter, or go to my website and you can get information about what I do. I have an active LinkedIn group called Bridging the Gap, and it really focuses on these types of topics, and it's really targeted actually towards immigrant investors and local investors. So please do so if you can. And then if you have any questions, come and speak to me. All right, thanks, Steve.
Okay, thank you very much.